Okay, so this video is on non-controlling interest, or NCI. So what is NCI? It is simply the equity in a subsidiary which is not attributable to the parent. So for example, if the parent acquires a subsidiary company, but they only purchase 60% of it, then that means the non-controlling interest is the remaining 40% ownership, okay, that somebody else owns. So when we are accounting for NCI, what we do is the parent consolidates the financial statements of the subsidiary as if they own 100% of it. So then the purpose of the NCI entries is to allocate the increases or decreases in equity that the NCI are entitled to them into a separate NCI account. So that NCI account remains within the consolidated group, but it just allows us on our consolidated financial statements to split out the amounts that we own as the parent from that consolidated group and the amounts that non-controlling interests own. So you can see here, this is an example where the net profit after tax is attributable to the parent and then the remaining portion to the non-controlling interests. Okay, so we separate the NCI equity from the parent's equity. So we've got an example here. So Deggers Limited acquired 60% of Rareco for $600,000 on 1 July 2015. The fair value of the NCI's share was $350,000. Rareco's equity is comprised of retained earnings, $600,000, share capital, $200,000. So all assets are at fair value except the land. Okay, additional information. Deggers Limited's inventory on 1 July 2018 included some purchased for $100,000 from Rareco. The original cost was $80,000. It was sold externally in December 2018. So it means that in the prior period, there was an intra-group transaction for inventory, and then we realized the profit in the current period. Then we've got Rareco sold an item of plant on 1 July 2018 to Deggers Limited for $250,000. Original cost $400,000, purchased on 1 July 2014. Original useful life 8 years. So we've got an intra-group sale of the plant in the current period. Then on 15 December 2018, Deggers Limited borrowed $200,000 to be repaid within 90 days. Interest expense of $200. So we've got intra-group borrowings in the current period. And we've got 28 February 2018, Deggers Limited sold $264,000 inventory to Rareco, so the sale price represents a 10% markup on original cost. And by 30 June 2018, 20% of inventory was sold outside the group for $60,000. So we've got a current period intra-group inventory transaction, and then we also have a realization of some of that profit. So prepare consolidation entries as at 30 June 2019. So this is just some additional financial statement information, which will come in handy later on through the process. So when we are accounting for NCI, there are two methods to recognize goodwill. So the first one is the partial goodwill method, and this means that we only want to recognize the goodwill that is attributable to the parent's acquisition of the subsidiary. So the way we do that, we know that they paid $600,000 for 60% of the subsidiary. So we have the total equity, right? We took the retained earnings share capital from the question. The BCVR we calculated on the revaluation of the land. And then we add up this total equity at the fair value. We multiply it by 60% because we're only purchasing 60% of the company. Now, so we paid $600,000. 60% of the fair value of the identifiable net assets is $513,600. So we know the goodwill that is attributable to the parent is $86,400. So that would be the partial goodwill method. We'd only recognize this goodwill amount here that is attributable to the parent. Okay, but full goodwill method, we want to recognize the goodwill, which is attributable to the parent, but also to the NCI. So the question told us that the NCI's the fair value of the NCI's 40% share was $350,000. So we use this as the consideration transfer. Again, we take the total of the identifiable net assets, which is represented by the total equity, and we multiply it by 40% because that's how much the NCI is entitled to. So the fair value of their share is worth $350,000, which is $7,600 more than the identifiable net assets they're entitled to. So they have goodwill of $7,600. So full goodwill method, we want to recognize the goodwill both attributable to the parent, but also for the NCI. Whereas partial, we only want to recognize the goodwill attributable to the parent. So the way we record that, okay, upon consolidation is for partial goodwill method, what we do is we do a simple normal pre-acquisition equity elimination entry, but for each individual line item of equity, what we do is we multiply the total amount by 60%. We only eliminate 60% of it because that is the amount that we as the parent actually own. Now the goodwill, we calculated in our acquisition analysis, and we need to eliminate the entire amount of the investment, which is $600,000, which is the amount that we paid. So if you're doing partial goodwill method, it's only these entries that you would do. If we're doing full goodwill method, what we do is we do these initial entries in green here, but then we would just add this entry as well. So we would debit goodwill by an additional 7.6k, and we'll credit NCI by 7.6k because that is the goodwill which is attributable to the NCI. Okay, so partial method, only the green entries. Full goodwill method, green and yellow entries. Okay, so after we've done that, we also need to do our consolidation entries, right? They're the same standard ones we've done in previous topics. So I'm just going to put them up on the screen with the information that they relate to. But I'm not actually going to spend time explaining them because I really just want to focus on the NCI entries. I'll put a PDF in the description which explains these consolidation entries, but then you can also look at previous videos if you need an explanation behind them. Okay, so first one, we have the land revaluation at the date of acquisition. Okay, that relates to this here. Okay, so that's a fair value adjustment. We have our upstream inventory adjustment. Okay, because there's the intra-group inventory transaction in the prior period, and then in the current period, there was the realization of that profit because it was sold externally. So we have the upstream plant sale and its depreciation adjustment. Okay, so Rareco sold plant to Deggers Limited. We are eliminating that gain on sale. There's the tax effect. We also have the subsequent depreciation adjustment. So that is an intra-group transaction for non-current assets. Okay, borrowings. So we're just eliminating the revenue and expense. It relates to this bit here. Again, intra-group borrowing. And then we have the downstream inventory sale. So again, we've just got the sale, intra-group sale in the current period. And we also realize some of that inventory in the current period as well. We'll realize some of that profit, not the inventory. Okay, so the one consolidation entry I will spend some time on is dividend paid. So this consolidation entry is the only one that actually changes. Right, so the reason is because in our intragroup transactions, normally what we're doing is we eliminate them in full because there's no actual change to the group's resources. Normally what's happening is that, say, cash, for example, is just being moved from one entity to another entity in the case of dividends. But for NCI, the non-controlling interest shareholders are external to the group. So when a dividend's paid, the NCI shareholders will receive the dividend and it will be paid out from within the group to those shareholders who are external. So we only eliminate the dividend revenue equal to the amount of the dividend that the parent is going to receive. So here, dividend paid for this example was $50,000. That comes off the financial statement information. And we know that the parent owns 60% of the subsidiary. So 50,000 multiplied by 60% is $30,000. So that is the amount of dividend revenue we're eliminating, because that is the amount that is staying within the group. The other $20,000 is being paid out to external shareholders, and so the group actually loses that $20,000 of cash. So now we're up to our NCI share of equity. So the first thing we need to do is we need to make our pre-acquisition equity elimination entry, but this time we need to do it using the ownership percentage of the NCI instead of the ownership percentage of the parent. Second, we need to look at the change in equity from the date of acquisition to before the current period. So because these NCI consolidation adjustments are only temporary, they're only done on consolidation, so we need to redo them every year. If the equity increases from the date of acquisition to before current period, we need to assign that increase to the NCI based on their ownership percentage. We also need to look at upstream intergroup transactions before the current period, because the subsidiary might make some profit, or they might have unrealized or realized gains from those intragroup transactions, which you need to adjust for. And we also need to look at the change in equity during the current period. So if the subsidiary makes a profit in the current period, then the NCI is entitled to the amount of profit based on the ownership percentage. We also need to look at the current period upstream intragroup transactions. The reason we look at upstream intragroup transactions only, because if you think about it like this, if the subsidiary sold an item of plant to the parent and it had a carrying amount of $200,000, but they sold it for $250,000, what would happen is the subsidiary would receive $250,000 in cash, and they would lose that asset worth $200,000. So they've lost $200,000 worth of assets, but they've gained $250,000 worth of assets, so their net equity increases. Whereas if you look at a downstream transaction, if the subsidiary buys some inventory for $100,000, they will receive inventory worth $100,000. So it'll increase their assets, but they'll pay $100,000 of cash. It'll decrease their assets, but the net change in assets would remain the same. So there'd be zero change. So equity would stay the same. There's no impact. So again, the reason behind all of these NCI transactions in general is because when we do our consolidation entries, we do it as if we own 100% of the subsidiary. So our NCI entries are taking or allocating the NCI's fair share of profits or losses to them in a separate account on the consolidated financial statements. Okay, so we're up to step one for the NCI entries. So what we're doing, this is our standard pre-acquisition equity elimination entry. Sorry, one too many. But the difference is, for each individual line item of equity, we take the total amount and we multiply it by 40%, because that's the NCI's ownership share. So for example, if we look at total share capital, 200,000 multiplied by 40% is $80,000. So we've done the same calculation for retained earnings and BCVR, and we've credited out NCI because that is the fair value of the net assets that the NCI is entitled to. Now, if we're doing full goodwill method, the NCI also has some goodwill that it needs to recognize, but we don't need to do it down here, because if you remember at the start, we recognized that goodwill of the NCI at the very beginning. So we don't need to then recognize it for a second time. Okay, so now we're up to our second step, which are our entries from the date of acquisition to before current period. So the first thing we need to look at is the changes in the equity. So in our case, at acquisition, share capital was $200,000, and on our financial statements, the share capital was still $200,000, so we don't need to adjust that. That stayed the same. However, retained earnings has changed. At acquisition, it was $600,000, but at the start of the current period, or at the very end at the period before now, it was $750,000. Why? Because these financial statements are at 30 June 2019. Our current period is the 2019 financial year. So the opening balance of retained earnings for the current period is the closing balance of the prior year period. So we know that retained earnings has increased $150,000 from the date of acquisition to the end of the period before now. So our NCI should get 40% of that increase because that's how much of the subsidiary they own. So we will debit our retained earnings. So we're transferring it from our retained earnings account to the NCI equity account. Okay, so 150,000 multiplied by 40% is $60,000. Next one, we have upstream sale of inventory. So Deggers Limited's inventory on 1 July 2018 included some purchased for $100,000 from Rareco, which the original cost was $80,000. So what this means is on 1 July 2018, which is the opening balance for this year, we had some inventory in our opening balance which had some unrealized profit in it. It means that the transaction happened in the prior year. So what we need to do is, upon consolidation, we eliminated the entire $20,000 gain on sale. So we reduced our unrealized profit by $20,000, and we also would have reduced our income tax expense by a corresponding $6,000. So what we're going to do is we will debit NCI by 5.6 thousand and credit retained earnings 5.6 thousand. Why? Because as I just said, we, upon consolidation, reduced our profits by $20,000. We reduced our expenses by $6,000. So that would be a net reduction to our retained earnings of $14,000. The NCI needs to share in that reduction of equity. Why? Because it was an intra-group transaction. The subsidiary is still within the group, just a portion of it is owned by a non-controlling interest. So $14,000 is the net reduction in equity, because I've put it over here as well. You can see we debited retained earnings for the current period. This is our consolidation entry by 20K, and we credited retained earnings opening balance by 6,000. So this represents the prior year's adjustment, which is what we are doing now, because we're doing date of acquisition to before current period. So the net of the debit and credit is $14,000. So the NCI shares in that reduction. If I take $14,000, multiply it by 40%, because that's the ownership percentage of the NCI, we get $5.6 thousand. All right, so that was that. Hopefully straightforward. NCI entries for current period. They make a profit in the current period. Surely the NCI is entitled to that profit according to the percentage of the company they own. So after tax, $56,000. If we multiply that by 40%, that comes out as $22.4 thousand. So what we do is we debit our NCI share of profit and we credit NCI. Why? The NCI share of profit is a profit account, so it makes up retained earnings. By debiting that NCI share of profit, we are reducing Deggers Limited's retained earnings, which is from the group's perspective, and we're giving it to the NCI. Because on consolidation, what we did is we would have taken all of that profit and claimed it to ourselves, but because 40% of that subsidiary is owned by NCI, we need to then reduce some of that profit and give it to the NCI. The next thing we then need to do, we've got upstream sale of inventory, so the realized profit. So we dealt with this, this piece of information in the last step, but the difference there was that we were dealing with the transaction which occurred in the prior period. Now we look at the end, it was sold in December 2018, so that occurred in this period. So that means because the inventory was now sold to an external party, the profit is now realized. So what do? We want to debit our NCI share of profit by 5.6 thousand and credit NCI again by 5.6 thousand. Why? Because we would have in the prior period been making the adjustment where we had debited the gain on sale to reduce our profits, whereas because the inventory has now been sold externally, we no longer debit our gain on sale. We no longer reduce our retained earnings each year. So because we are no longer reducing our retained earnings by $20,000 every year, it will appear as if our retained earnings has in fact increased by $20,000 each year. And so the NCI should share in that increase in retained earnings. So the profit has now been realized because inventory was sold outside of the group. So if we take that $20,000, we then multiply it by 40%, that gives us $8,000, but we want the after-tax amount. Once you realize profit, you need to pay tax on it. So we've multiplied the 20,000 by 0.4 to represent the NCI's share. We then multiply it by 0.7. This gives us the amount of equity they're entitled to after tax has been paid. So we debit the NCI share of profit because we want to reduce the retained earnings of the group, and we want to give some of that retained earnings to the NCI. So we credit their NCI equity account. So the next thing we do, we look at the upstream sale of the plant. So there's an unrealized gain. So Rare Co. sold an item of plant on 1 July 2018 to Deggers Limited for $250,000. So the original cost was $400,000 purchased on 1 July 2014 with an original useful life of 8 years. What this means is, because the original cost was $400,000 with an original use life of 8 years, we will have depreciated it 4 years already. From 2014 to 2018 is 4 years. So 400,000 divided by 8 is $50,000. So that's a $50,000 depreciation expense every year. So after 4 years, the carrying amount of that plant will be $200,000. So the gain when it's sold for $250,000 is $50,000. But because it is an unrealized gain, because it's an intra-group transaction, what we will have done on consolidation is we will have debited that gain on sale because we wanted to completely remove it, and we would have reduced our income tax expense because we were reducing our profits. And so that affects our retained earnings. And so the NCI needs to share in that reduction in retained earnings. So the unrealized gain was $50,000. If we multiply it by 0.4, we know that the NCI was entitled to $20,000 of that unrealized gain, but we want the after-tax amount. So then we multiply it by 0.7, and so that gives us to the $14,000. Okay, so next thing, we're continuing on with the current period entries. So we have upstream sale of plant, realized gain. So what this is saying is there was that $50,000 difference between what the original carrying amount was and what we sold it for. So from the group's perspective, we will want to depreciate it using the original carrying amount, which was $200,000. So we'll depreciate it at $50,000 a year. But when we sold it, we recognized at $250,000. The remaining useful life is still 4 years, so we will depreciate at $62,500. And so every year we need to make this depreciation adjustment, which reduces our depreciation expense by $12,500 every year. Now the NCI will share in this reduction because the subsidiary originally owned the plant, and so they sold it up to Deggers Limited. The way they realise this gain is every year the difference between the depreciation expense, what it should be from the group's perspective, and the actual depreciation expense which is recorded is the amount of realised gain per year. Why? Because when you depreciate something, you're saying that you have received the economic benefits from it, and so you can realise the gain from the subsidiary's perspective over that period. And that's represented by our reduction in depreciation expense. So our $12,500 is our depreciation adjustment. And so if we multiply it by 0.4, that gives us the amount that the NCI is entitled to. If we then multiply it by 0.7, that gives us the after-tax increase in equity that the NCI is entitled to. So we're debiting NCI share of profit by $3,500 because we want to reduce our retained earnings as the group, and we will credit NCI by $3,500 so that they are allocated that increase in equity as the profits realized as the plant is used up. So the final thing is we've got the dividend paid. So we can see dividend paid was $50,000. We will be debiting NCI 20K and we'll be crediting dividend paid by 20K. Why? Because when you pay a dividend, you pay it out of retained earnings. And so what this means is that your retained earnings decreases. So the NCI should share the reduction in retained earnings. And so we debit the NCI by their share of the dividend because their share of equity has reduced by the same amount of the dividend that they would have received because they're taking cash out of the subsidiary and external to the group and holding it in their hand as external shareholders. And so the equity that they are now entitled to is less than what it was before. So what we do, we reduce the equity by NCI by 40% of the total dividend paid, which was 40% by 50,000, gives us 20,000. We credit dividend paid to increase the equity for the group because NCI needs to take their fair share of that reduction. So in general, intra-group adjustments, okay, so before I say that, that's the entire process, it's done. Just generally intra-group adjustments for steps 2 and 3. So subsequent adjustments on revalued assets will decrease NCI equity. Why? If you have a piece of plant at a carrying amount of $100,000 at the date of acquisition, but its fair value is $200,000, you'll increase it to that $200,000 and you'll depreciate it based on $200,000, not $100,000. That means that your depreciation expense would be double every year, which means you'd have less profit every year. So the NCI would need to share in that reduction in profit. So that would decrease NCI equity. The second one, unrealized gain on upstream asset sales. So if we use inventory for the example, let's say the subsidiary has $80,000 of inventory. They sell it for $100,000 to the parent. It's an unrealized gain of $20,000. It's an intra-group transaction. We need to eliminate that gain in full. So we'll be reducing our profits. The NCI needs to share in that reduction of profit. And so that will decrease the NCI's equity. And then realized gains on upstream asset sales. This will increase NCI equity. Why? Well, once you sell inventory externally, so if we go back to that same example, we had that $20,000 unrealized profit. Once you sell it externally, that $20,000 becomes realized, and so everyone is now entitled to that profit. So the NCI can take their fair share of that realized profit. And so that's why the NCI equity will increase. And the final one, when the parent derives economic benefit from the upstream asset sales. So when that plant at carrying amount of $200,000 was sold to the parent for $250,000, we realized that gain every year equal to the amount of depreciation expense adjustment, because we were saying that as the asset is used, we realize economic benefits from it. So the subsidiary can then realize that gain they made on the intra-group adjustment from the NCI's perspective, because NCI is external to the group. They should take their fair share of profits from that reduction in expense every year, because we will only be depreciating it at the original carrying amount, not the subsequent higher amount that we sold it at. Okay, finally, the overall process, just to try and make it clear, is one, we do our acquisition analysis, work out our goodwill attributable to the parent, our goodwill attributable to the NCI. If it's a partial goodwill method, we only need to recognize parent goodwill. Full goodwill method, we recognize both the parent and the NCI. We do our pre-acquisition equity elimination entry. So we eliminate the equity for the parent based on the ownership percentage. We also recognize the goodwill for the NCI in that stage if we're doing full goodwill method. We then do our standard consolidation entries. We then do our NCI pre-acquisition equity elimination entry. That's the same as step 2, except we just use the NCI ownership percentage. We then do the NCI date of acquisition to be for current period adjustments. And then we work out the current period adjustments. So that is the overall process. Okay, this is steps 4 to 6 is what we focused on in this video mainly. All right, so I hope it was useful.